Welcome to the Lend Academy podcast, episode number 132. This is your host, Peter Renton, founder of Lend Academy and co-founder of Lend It. Support for the Lend Academy podcast and the following message come from Wonder Capital, allowing individuals to invest in solar projects. Earn up to 7.5% annually while diversifying your portfolio and combating global climate change. Create an account for free at wondercapital.com/lendacademy. Wonder Capital, where impact investing meets capitalism. Today on the show, I'm delighted to welcome Camilo Concha. He is the CEO and founder of LendingUSA. LendingUSA is an online marketplace lender, but they are a little different because they are a point-of-sale lender, and they are point-of-sale lender in just a few focused verticals. We talk about that. We talk about the different verticals. We talk about how they underwrite, the importance of having a very quick and automated underwriting process as someone is sitting at the point of sale, wanting to know if they're approved. And we also talk about how they're scaling their business, how they're funding these loans, and a lot more. Hope you enjoy the show. Welcome to the podcast, Camilo.
Thank you so much, Peter. I appreciate being here.
Okay, so why don't you get us started by giving the listeners a little bit of background about yourself and what you did before you started LendingUSA?
Yeah, so a little background on me. I was born and raised in Bogota, Colombia. I moved here when I was about 14 years old. Lived in Los Angeles ever since. I had the privilege to work for the Bar Association while I was going to college. After college, I worked for a major consulting firm in business turnarounds and doing some critical analysis for businesses. In my early 20s, I basically started my first company, and I ever since just been on my own trying to build great businesses.
Mm-hmm. Okay, so then tell us a little bit about the founding story of LendingUSA. What led you to create your latest company?
Yeah, so early on, my first company was a platform that matched consumers with attorneys. This company was called Attorney Search, and it basically allowed them to help each other out by matching them online. I took that same concept and started a company called 1-800-MY-SURGEON that matched cosmetic surgeons with consumers. When we started that company, we realized early on that there was a huge need for financing. So we decided to create a company called medicalfinancing.com. Medicalfinancing.com was a platform that matched consumers again with lenders, finance companies, and anybody who wanted to participate in the lending environment. We ran that company for many, many years, and we acquired other brands along the way because we realized the opportunity was a lot bigger. So we acquired dentalloans.com, bridalloans.com, petloans.com. And about 2015, we were generating roughly about $1 billion worth of application flow.
Wow.
And after all those years working with all these financial institutions and consumers, we learned many lessons on what worked and what didn't work. So I felt like it was time to create a better point of sale experience for the consumers and the merchants. I decided to attend one of the Lend It conferences at the time. And to my surprise, our concept was really well received. And not only that, we were able to find sort of the pillars of our business. We found and connected with Cross River Bank. We connected with First Associates. And we found direct lending partners as well as online lending partners to raise, to give us the capital for us to operate. And, we still have those partners, but basically that's sort of where it got started. 2015 is when we put it all together at one of the Lend It conferences.
Okay, so that's great to hear. So then, as far as what you're offering today, and you've talked a lot, you mentioned a lot of different verticals, cosmetic surgery, pets, medical. What are the verticals? What are the offerings that you have today on LendingUSA?
Yeah, so that's a great question. Our core product is aimed at solving two things. For the small business owner, we help them grow their business by allowing them to capture more sales. And for the borrower, it's about financing the important moments in lives. We offer installment loans and focus on verticals that make a difference on people's lives. That's sort of our focus.
Mm-hmm.
We operate mainly in the elective medical industry, verticals such as bariatrics, dental loans, cosmetic surgery. We also are focused in the pet market as well as funeral.
Okay. So how does it work? So you go into, your dental office or your cosmetic surgeon, and you talk about a procedure that you would like to get done, and then they say, well, that's going to be $4,000, and you think, oh my goodness, I can't afford that. So how does it actually work at the actual point of sale?
Yeah, so basically the consumer goes for a consultation at the doctor's office or the merchant, and they are quoted a price for the procedure. The consumer, either they have the ability to pay for that or they don't. They let them know the advantages of using financing. The doctor or merchant basically will tell them, hey, these are the financing options available. The consumer will fill out an actual application at the office. They will get an instant decision, and then the terms of the loan will be reflected on the computer that they're using or the tablet. If the consumer decides to move forward, an online installment contract will be generated, and this whole process takes only about 4 to 5 minutes on average.
Mm-hmm. Okay. And then, so what are the actual terms of the loans typically? I mean, how long are these loans? What are the interest rates? What's the typical size?
Yeah, so the current offering that we have is loans that are either 36 or 60 months. We will be expanding that in the near future, but as of today, it's 36 to 60 month loans.
Mm-hmm.
The average term is somewhere around 44 months, so right in the middle. And the average loan amount it's close to $6,000 today.
Okay. And what about interest rates? What's the range on those?
So the interest rates start somewhere between 14.99 all the way to 29.99.
Mm-hmm.
Our average interest rate, it's somewhere around 22% today.
Okay. So then, can you just share a little bit about the typical borrower? Do you have sort of a sense of who they are, like how old they are, what sort of salary level they're at, FICO score, that sort of thing? What does a typical borrower look like for you?
Yes. So obviously the typical borrower changes a little bit from vertical to vertical, but
Sure.
I can tell you that overall, we're focused on what we call prime and near prime customers. Our average credit score is somewhere around 683 today.
Okay.
The average income is about $75,000.
Okay.
Just to give you a range.
Right. Okay. That sounds good. So then, you really are, you're sort of just at the lower end of prime on average, I would say. So, and then as far as acquiring these customers, I mean, you're obviously, the key for you, I imagine, is you're really operating a business to business kind of company, because it's key for you to have, once you get in on the merchant, it's the merchant then that is going to be providing this as an option to the consumer. You're not going to be doing that, I presume. So how do you go about, like, what's your sort of strategy for acquiring new merchants?
Yeah, so we have obviously created an offline and online approach for acquiring merchants. We go all the way from integrating to software providers to creating exclusive agreements with associations. We have a very strong presence on the SEO, for SEO purposes on our websites. We rank usually in the first page for many of the key terms. We do a lot of display media advertising, offline mailers. I mean, we really do an overall gamut of marketing that allows these merchants to come in to us. We do a lot of outreach and sort of, podcasts and a lot of different things that allow the merchant to find out what we do. And we're more of a consulting sort of approach is what we normally do today.
Right. And do you get many borrowers coming to you directly, or is it pretty much all through the merchant?
No, it's actually great you mentioned that, because we acquired so many brands throughout the years. There's a lot of people that come to us directly from the internet. A lot of people start their search for a merchant at their house. We call those virtual clients. Mm-hmm. So they'll start with that, and we capture them there, and then we basically follow them through all the way to the merchant level. So we do get them directly from the merchant, but we also get some of our clients come directly to us from just them searching online. Right. So we get both.
Right. Okay. And then when the merchant is, providing the rate and everything, I presume you're completely out of that equation. Is that correct?
Yes.
Yes,
We're definitely out of that equation.
That's the conversation between the provider and the customer. So, okay. So then, what are the economics like for the merchants? I mean, how do they? I mean, obviously they get the additional sale if this person can't afford it, they walk out the door and they've lost forever. But if they get them signed up, I mean, do you do any kind of sharing of revenue with the merchant, or how does it work?
Yeah, so what we're basically doing is we work with the merchant by allowing them to capture more clients. Mm-hmm. In exchange for that, and to provide a great experience for their clients, we basically provide them with a platform that they can use. They can track all their clients, and in exchange for that, we charge them a fee. That fee ranges anywhere between 0 and 10% of the actual procedure.
Okay.
Or transaction.
Okay.
The average is somewhere around 6% today, but that's sort of a fee that we charge to provide this type of service to the merchant.
So the borrower is not paying an origination fee. Then they're just, to them it's just it's just an interest. They're paying interest without paying an origination fee. Is that correct?
No, they actually do.
They do. Okay, so you get them on both sides.
Well.
You get the merchant and you get the consumer. That's a nice little revenue stream for you guys.
It is, and I'll tell you something else. We also get paid on the performance of the portfolio. So once we hit the number that covers our interest, anything over that, that's also part of our profit. So okay. we basically make money from 3 revenue streams: merchant fees, borrower's fees, origination fees, and the performance of the portfolio as well.
Okay, interesting, very interesting. So then let's talk about underwriting and how you approach it. You're obviously going to be seeing a whole variety of different customers that are coming through your platform. And what is your approach to underwriting? How do you obviously they want a decision quickly, and they don't want to have to sit around waiting for days or weeks for anything to be approved. So tell us how that process works.
Yeah, so I mean, all the underwriting that we do is automated, right? So there's not humans don't make any type of decisions. It's basically we capture the credit, we do all the checks in the background, and we make a decision on the spot. Mm-hmm. The way we created an underwriting model was we use publicly available data from Lending Club. They were gracious enough to have that data out there, and we were able to take that data to build our initial model. We retained the services of Dr. Bryce Mason is a former employee of the Rand Company,
yep,
who used to do a lot of work in the industry for banks, buying loans for big banks. He helped us build our initial model. Last year, I hired a gentleman named Sharat Shankar, who's our Chief Operations Officer and Risk Officer. He came from a company called Lending Point, and he came with the mandate to invest significantly to improve our fraud mitigation and also help us model and create our next generation underwriting model. That's been sort of the approach. We feel that this is we have to keep going and improving our model. Things they're always changing, so we're trying to stay ahead of the curve.
Mm-hmm. Sure. And so, can you just give us a sense of then the scale you're at? I mean, when did you issue your first loan? You talked about at Lendit in 2015, you sort of got everything together. But when did you issue your first loan, and what scale are you at today?
Yeah, so the first loan was probably done somewhere around 6 months later after Lendit, around that time. So we only had the first 6 months. We did $8 million in transactions for
right.
6 months. The second year, complete year, we did about $60 million. This year, we do somewhere about $160, $180 million. Mm-hmm. We're trending to do about $15 million a month today. We expect to do anywhere between $250 to $300 million next year in originations.
Interesting. Okay. And so then what can you tell us about the performance of your portfolio so far? I mean, you're still obviously fairly young with a 44-month average duration, although I'm sure some of them have already been paid off. Can you give us some sense of the performance?
Yes. So our loan performance has matched our initial models surprisingly closely. We always knew that our defaults would be higher than lending clubs because, they had a lot more experience. They've done a lot of iterations.
Mm-hmm.
But we always felt that because we're at the point of sale, we are allowed to charge a little bit of a higher interest rate to offset some of that risk.
Right.
So our typical yields are somewhere around 600 to 800 basis points higher than you would find on Lending Club.
Mm-hmm.
And our defaults are somewhere around 200 to 300 basis points higher than Lending Club. So I think net yield compared, same risk buckets, we're probably 400 to 500 basis points a little bit ahead on what you normally see on the market out there.
Right.
And I think that's been one of the great things about what we built is we don't have to compete to get the lowest possible interest rate because we're at the point of sale and when you're at the point of sale, you don't have to focus so much on that. You have to focus more on service, on making sure that you provide the right loan for the right client. And that obviously changes the equation a little bit. Right,
sure. So when you're for most of these merchants, are you the only offering that they're providing, or are you competing with others at the point of sale? So they're like, I'm just, I mean, obviously they don't want to go through the process multiple times, but I'm just thinking if there's someone that doesn't fit in your credit box, do these merchants typically have other options, or what happens there?
Yeah, so there's different ways that this gets done. Some merchants basically have a decision tree where they say, okay, this company goes first, this company goes second, this company goes third. Some merchants just use one lender, mm-hmm. and some may send it to multiple lenders. Everybody does it a little differently, right? So sometimes we will find ourselves, they may run an application with Care Credit, which is sort of one of the big companies in the industry. And then, they may send it to us after, or they may go to us first and then send it to them after. There's no real way to everybody has a way to do it.
Mm-hmm. Right. So it's possible that you may be competing with some merchants head to head, and in other places you've sort of got somewhat of an exclusive arrangement. So then, just on that, like, what percentage of borrowers are you rejecting because they just don't fit in they're too subprime, or for whatever reason they don't fit in your credit box?
So today, our approval rate is somewhere about 35%, right. Somewhere along those lines. Mm-hmm. We are not looking to be in the subprime market. We want to stay in the prime and near prime market. Mm-hmm. And we feel that our model was created to coexist with companies like Care Credit. We're not trying to compete head to head with anybody. I think it's not a good idea to do that because that becomes a zero-sum game, mm-hmm. where nobody wins. We're trying to sort of create our niche market for what we do and the type of loans that we feel that we can do better. We focus more on installment loans. So installment loans are definitely different than revolving lines that are out there.
Right.
So they work better for some clients. We can provide a higher amount. So we just try to coexist overall.
Right. So I imagine that fraud is probably less of a problem for you than the pure online lenders, like Lending Club, Prosper, and whatever, because this is an in-person. Because this point of sale, by its very nature, it's going to be in person. Most of what you do, I imagine, is when someone's coming and they're sitting across the table from a practitioner of some sort. So what is fraud like for you guys? Is it really a minor problem?
You know what? It's not a minor problem because we don't have the same issues that you would find in lending clubs and Prospers of the world, where you have so much consumer fraud. Mm-hmm. But where the fraudsters try to do is they try to create fraudulent merchants. Right?
Ah, right. Yep.
So they go the other route. So obviously, if they're able to go through as a fraudulent merchant, then every application that comes through will be fraud.
Right.
So we don't focus so much on the consumers. We focus a lot more on the merchants. Because if the merchant it's a real merchant, the consumers, most of the time, with the exception of some familial fraud, will be actually real.
Right.
But if the merchant, we let them through our doors and they are fraudulent merchants, I guarantee you that that's a big number. We've been able to contain that very much because we are very strict on who we allow to do business with. We do a lot of background checks. We really do a lot of due diligence. Mm-hmm. But there is that issue out there for sure.
Right. That makes sense because that would be you could suddenly, it's not like one loan. It could be 100 loans that are all going to go bad.
Exactly.
Yes.
Yeah. Mm-hmm.
Okay, so let's talk about the investor side of the business, or the funding side, shall we say? How are you funding these loans? Where are you getting your sources of capital?
So our operating capital came from direct lending investments and a company called Lending Partners. It was a partnership with the Mirage family, the Hot Pockets family. They give us the initial seed capital to start our company, and then Lending Partners give us the capital to lend out for our loans. Mm-hmm. We basically have a line now. We're about $200 million with direct lending partners. We just recently, about 2 weeks ago, got another $50 million warehouse line from CapSource, and we're working a couple other ones from some major banks for $100 million. So we basically, started. We were lucky enough to meet with direct lending partners. They believed in us, and they've been amazing partners for us. And we now have gone beyond and looked for banking relationships as well, and we were able to accomplish that recently. We are now looking for forward flow agreements and selling some of our loans, and ideally we want to be able to securitize our transactions sometime in 2018.
Okay. So I saw that. I think it was just a press release that came out yesterday. And that had the CapSource thing on. So direct lending, that's Brendan Ross's company, right? Is that who's providing?
That is correct.
Right. Okay. We've had
Brendan. That is Brendan.
Brendan's been on the podcast here a couple of times. Actually, I've known him for many years. That's great. I think he I know he speaks highly of you guys when I've spoken with him about it. So I wanted just to get a sense on, it seems like you're going along pretty well. You're growing reasonably quickly, but as you know, in this business, it's not as easy to raise equity capital as it used to be, and everyone wants to know how close you are on the path to profitability. So, what can you say about that? Is this a 2018 goal for profitability, or what?
Yeah, we're very close to profitability. And candidly speaking, the only reason why we're not there is because we keep on reinvesting for growth.
Sure.
So we're very close. Our economics between the merchant fee, the origination fee, and sort of the upside of the portfolio are very strong. And as we start lowering our cost of capital, we are exponentially going to become very, very profitable. So we're on our way to get that done today. But we are very much focused on what we call controlled growth, meaning we have a path of growth that even though we can do more, we're trying to maintain that path so we are responsible as far as how much we have to raise, and we don't go out there and do $1 billion and then disappear the next year. Mm-hmm. So we're taking the slow approach, the methodical approach, and yes, we're not growing as fast as everybody else is, but we're definitely steady. We feel that this is a marathon, not a race. Mm-hmm. So that's the approach that we're taking as far as our business.
Right. Well, it's interesting. You've grown your business in a reasonably difficult time period, because if you launched late in 2015, and then we saw an investor pull back from marketplace lending in general in early 2016. Then we had the Lending Club issues. And it sounds like those kinds of things haven't really impacted you, or maybe I should ask the question: has that been? Have you seen sort of a lot of people questioning, and has it been difficult to get that investor capital given what has happened in the marketplace lending space over the last couple of years?
Yes. So the answer is no. It has not been more difficult, and I think the real reason behind it is because we have a completely different model than what you see out there. And what I mean by that is we basically are signing up doctors and merchants one by one, the old sort of school way, hundreds and hundreds of merchants every month that we sign up. And they're kind of like an annuity if you think about it, right? Once we sign them up and they start sending us business, the cost of acquisition keeps going lower and lower as they send us more and more loans over time. So I think the investors are very savvy, and they look at that cost of acquisition. They look at our yields because we're able to charge a little bit more, and they realize that the opportunity is there, and that it's a different type of business model than what they're normally seeing out there. So we've been very lucky where we have strong partners that believe in what we're doing, So we have not seen that yet.
Right. Okay, that makes sense. You're not competing head to head with all the other lending clubs and Marcus and Avant or whatever. You're doing. You got a slightly different niche, and you just said something there that was really interesting to me. Like your cost of acquisition is going down, and I think your cost of acquisition really is once you've got merchants in place. I imagine you pretty much have a zero cost of acquisition in some ways because you're getting a fee back from the merchant for underwriting these people. So and then it's a case of getting more and more merchants on. So I could see how that's a really that is an appealing model, and I could see why your investors would be more positive on it than just the general the sort of more standard marketplace lending model. But then what I'm curious about then what has been your biggest challenge in getting your business to where it is today?
So the biggest challenge, I believe, is that it's very difficult to be great at one thing, right?
Mm-hmm.
And it's much more difficult to be great at four things. Meaning, in this business, you have to be great in sales, you have to be great in underwriting, you have to be great in technology, you have to be great in financing and raising capital. Like, you have to really be great at a lot of different things to be successful. So it's challenging to be able to put all those things together into a nice little bouquet of success.
Right.
So that's been challenging.
Mm-hmm. Yeah, no, that
we're learning every day about something. Yeah,
aren't we all? That makes sense. Okay, so then we're almost out of time, but so last question. I mean, what's your long-term vision here? Is this you want this to be in every doctor's office, dentist's office, funeral home, what have you in the country, or what's your long-term goal here?
Our long-term goal is very simple. We just want to be the number one provider in the markets that we service. That's our main goal. We're not going to be in a bunch of markets, but the ones that we're going to be in, we want to be the number one provider.
Okay. Well, that sounds great. And I certainly wish you all the best of luck. I appreciate you coming on the show today, Camilo.
Thank you so much for your time. We really, really appreciate it. And, thank you for what you guys are doing with the industry. I got to tell you, without you guys putting this great sort of conventions together, we wouldn't be here. So thank you.
Oh, you're welcome. Okay. Well, thanks very much, Camilo. We'll talk to you later.
Sounds great. Thank you.
Bye. The point of sale market is a really interesting one to me. It's one that as we just talked about, there are some unique advantages to the lending platform, but it's also one that I think is going to be going through a rapid transition. We've seen really successful companies like Green Sky, Affirm, and Bread coming out that are other point of sale companies, not necessarily competing directly against LendingUSA, but they are all innovating on the point of sale. I think that the credit card business is obviously been the default financing mechanism for most point of sale transactions. And that could be changing. In fact, I'd be surprised if over the next decade that doesn't start to shift dramatically. And companies like LendingUSA are going to be at the, they're going to benefit from, and they're going to be at the forefront of that shift. Anyway, on that note, before I sign off, this is our last podcast of 2017. I would like to thank every one of you very much for listening throughout the year and for helping to make this podcast a success. I'd like to wish you all a safe and happy holiday season and all the best in 2018. We are going to be off next week, and we'll be back in 2018 with some more great guests. Thank you again for listening, and I'll catch you next time. Bye. This episode was brought to you by Wonder Capital, the leading solar investment platform. With Wonder, individual investors like you can now invest in large-scale solar energy projects across the US, earning up to 7.5% annually and helping to fight global climate change. Wonder's newest fund, Wonder Capital 5, has raised more than $5 million from investors in its first 60 days. Create an account for free at wondercapital.com/lendacademy and commit your investment before January 1st to take advantage of Wonder's holiday special, 0 investor fees. Act now because starting in 2018, new investments will be subject to fees. Wonder Capital, where impact investing meets capitalism.